Charles, we've heard from a number of people that we shouldn't take the dot plot too seriously. I think Steen Jacobsen just told us that his golden retriever was better at forecasting rates going forward. But the market does seem to pay attention when it moves around. Is that going to change?
No, I don't think it's going to change. People will inevitably pay attention to what the Fed committee members are thinking. As far as we're concerned, the economy is slowing significantly, and so I would expect the expectations as regards future interest rates to come down a little bit.
So you expect the dot plot to move down a little bit. Do you expect the Fed to take interest rate increases off the table for 2019?
We think that the Fed will probably be cutting interest rates and essentially reversing the December hike probably in the third quarter. They'll start off today, we think, by getting rid of, well, essentially explaining when QT will stop. And we need to remember that last year, the Fed's balance sheet shrank by $373 billion, and that raised the amount needing to be financed by the market from $560 billion in 2017 to $1.5 trillion last year, allowing for the much enlarged budget deficit. And that's one of the reasons why rates went up so much last year. Now, the stance is a lot easier now, and the economy is slowing down because the dollar's too high. So there's every reason to expect that they will be easy.
What if the U.S. and China come to a good trade deal? Or maybe I should ask it this way. Are you assuming that the U.S. and China don't come to a particularly effective trade deal?
No, I'm not. No, not at all. The reason for the slowdown is the damage that was done last year by the huge hike in the dollar and the slump of the Chinese yuan, which imposed enormous penalties on everyone else because it made imports much more expensive, and it also made foreign debts in dollars much more expensive, at the same time as exporting became more competitive because of the Chinese yuan going down. And that induced the emerging market bloodbath last year, which led to austerity programs, which, together with China's domestic demand slowing down, means that the world at large is slowing down sharply, and the dollar's very high, and so it's spreading to the United States. This is a lagged effect of what's already happened.
Do you see a recession coming, Charles? I just was reading a column by Gary Schilling, admittedly a noted bear, but he was saying a recession is in the cards, possibly even for this year, and certainly if the Fed raises rates again, that could push us over the edge.
Well, as I say, I don't think the Fed will raise rates again because I think this is a much more market-sensitive Fed than we've had before with Yellen and Bernanke. But having said that, we don't expect a recession this year anyway because the US is slowing down. It's not going into recession as we see it. The consumers are helped by much cheaper oil prices, even though they're to some degree hurt by the drop in the stock market at the end of last year. But we've had quite a bit of recovery, and in fact we're probably about 2/3 of the way back towards the September-October peaks. So you know, the overall state of things is not heavily negative. It's just modestly less buoyant than before.